So, with many people, including myself, believing that the stock market is being propped up right now while the economy is barely scraping by, one investment strategy that a lot of people have been turning into is dividend investing. Which is because if the company is stable enough and management is committed to paying out those dividends over a long period of time, dividends can be a great steady stream of income. In today's video, we will discuss about 5 stocks that I favor for long-term dividend income. But keep in mind that this is just my own point of view. Please conduct your own research and obviously only purchase stocks at a price that you are comfortable with based on your own thorough investigation. But with that stated, we've got a lot of ground to cover, so let's get this started. But before I forget, let me welcome you to the Smart Stocks Academy channel. To be the first to know when a new video like this is released, hit the like button, subscribe, and click the notification bell next to it. Now, let's get to the video. So, the ETF that I picked for today's video is the Vanguard High Dividend Yield ETF, which is obviously focused on dividend. There are several reasons why I enjoy this one in particular. For starters, with a yield of close to 2.8%, it is right up there with some of the best ETFs on the market, especially considering that it is not just holding a bunch of risky stocks like oil stocks or real estate investment trusts, which can give you a higher yield but also come with a lot more risk. Despite its high yield, it has a growth rate of 3.12% and 14 years of consistent growth. Now, they did lower it slightly during the Great Recession, but not significantly, and they quickly returned to solid growth afterward. So as long as you didn't sell and instead added to your position during any of those dips, you should have come out ahead with this one. Which brings me to another reason why I like it. That said, it is down a lot this year, with a year-to-date increase of just 0.10% at the time of this recording. Granted, it was down even more during the March lows of this 2020 crash. But given how high the overall market has been recently, picking up this ETF at around the midpoint of its 52-week range doesn't seem like such a bad deal to me. As you can see from this chart, this is not a high-flying ETF by any means. Instead, it is more of a long-term dividend investment that you can bank on for some pretty excellent stability and some nice payouts. Which leads me to the third reason why I like it, which is how well diversified it is. It screens a large number of high-yielding US companies, but it also excludes riskier real estate investment trusts, which are then weighed by market capitalization rather than dividend yield. As a result, it has more exposure to larger, more stable companies with lower yields. But the trade-off is a more stable and reliable ETF. By the way, as is characteristic of Vanguard, their expenditure ratio is extremely low at only 0.06% each year. Coming in at number 2 is of course AVI, which is one of my favorite biotech stocks that still trades at a reasonable price and pays a very high paying dividend. Now, this one does come with a risk, which we will discuss shortly, but after I watched them collapse down to $60 level in 2019, I thought the stock was much too appealing to ignore, and I ended up investing into it for the first time ever. Today, the stock has rebounded all the way back up to the $160 level, leading you to believe that the valuation and yield are no longer appealing. They're not only still appealing, but they're also still among the best on the market. When it comes to pricing, they have a forward PE ratio of about 11.9. You'd expect the stock would be more costly given the enormous dividend that they pay out. In fact, despite the payout ratio remaining low at less than 50%, and the 5-year growth rate being extraordinarily strong at 17%, their dividend now yields to 3.34%, making this a very attractive dividend growth company that often trades for a premium. The dividend growth history is possibly the best aspect of all. AVI has grown for 48 years in a row, putting it on the verge of dividend king status. The danger presently comes from its best-selling medicine, Humira, losing patent protection, which it already has in Europe, and will soon lose in the US. But despite that, I believe that there are a few reasons to be positive about AVI's future. For one thing, they just won a case that will help them maintain Humira's market dominance in the United States for at least a few more years, allowing them to make billions before biosimilars begin to eat into their revenues. Meanwhile, this gives AVI more time to continue developing a strong pipeline of new products that will help them compensate for reduced Humira revenues in the future. This is demonstrated by the early success of novel immunology medications such as Skyrizi and Rinvoq, as well as blood cancer drugs such as Imbruvica and Venclexta. Not to mention that the recently completed acquisition of Botox producer Allergan, as well as lucrative licensing partnership arrangement with Genmab, should only help AVI's free cash flow, which is already at an all-time high of over $16 billion in the year 2020. That should easily allow them to maintain their already big dividend, and I can't think of too many other biotech stocks with a more appealing yield or valuation than AVI. Therefore, I believe they deserve to be on today's list. Now, let's move on to stock number 3, which is PepsiCo, which is another one of my largest and personal favorite dividend stocks in my portfolio. This one is straightforward because there is basically nothing negative I can say about them. With a dividend of over 2%, this is a fantastic investment. Even after growing the dividend for 49 years in a row, the 5-year growth rate is close to 8%, giving them Dividend King title after they hit the 50-year threshold. The main drawback is the extremely high payout ratio of over 78%, which means I don't expect the dividend to rise much in the future. But it is still one of the most consistent 2% payouts available, which you can bank on all the way until retirement. That's because Pepsi is one of the most stable and dependable businesses in the world, regularly generating strong sales and excellent profits year after year. Again, this is a testimonial to their large range of goods and varied company, which in my opinion is far superior to their main competitor Coca-Cola, who primarily sells drinks. That isn't to suggest that PepsiCo doesn't have a sizable beverage portfolio to compete with Coca-Cola. With beverages like Pepsi, Mountain Dew, water like Aquafina and Life Water, high-growth sparkling waters like Bubbly and SodaStream, sport drinks like Propel and Gatorade, and even an exclusive collaboration with Starbucks to package and sell some of their merchandise. But the point is that their solid food section is what I believe sets them apart from the competition. In reality, because of their diversity, PepsiCo was able to survive the dreadful second quarter, which some economists predicted would send US GDP plunging by almost 50% at one point. Of course, a strong company like this almost don't ever deal for a low price. But if you can get it during a plunge, which you can see on this chart here, they do have plunges on occasion, and just keep adding to your position every time it does, you'll probably make big money over the long term, both from the stock price and from the incredible dividends. Moving on to stock number 4, we're going to go with NextEra Energy, which happens to be my personal favorite utility and energy company. The reason why I like this one the most out of all energy companies is that NextEra is focused on future of renewables, rather than older legacy businesses or industries like coal, oil, and gas. That isn't to say they don't employ those ways now, but the majority of their energy comes from cleaner natural gas. And they have big plans to provide more and more energy from wind and solar in the future. In fact, its Florida Power and Light subsidiary wants to build more solar capacity than any other regulated utility on the planet. That corporation is already the largest electric utility in the United States when it comes to retail power produced and sold. NextEra is continuing to put up solid growth rates and is likely to do so for the rest of this year and the next. Unfortunately, the stock's strong current performance combined with its bright future means you will have to pay a premium for it because it almost never dips. But you do get a very nice growing dividend in return, with a yield of 2%, a double-digit 5-year growth rate, and a solid 27 years of consecutive growth. Now, onto the company with the highest yield on the whole list, AT&T, which has a tremendous dividend yield of approximately 5%, And with such a high yield, you'd think that their growth history couldn't possibly be that substantial. But they've actually risen it every single year for a massive 37 years in a row. Of course, the payout ratio and 5-year growth rate are both a little high and low, but I believe anyone would be ready to accept those trade-offs in exchange for such a high present income. Here's the thing with AT&T. At a time when so many companies are, in my perspective, overpriced due to the economy's weakness, AT&T is still trading in my favorite price range of less than $25 per share. They bought out DirecTV for over $50 billion in 2015, only to buy Time Warner for another $85 billion in 2018. My concern is how much this will hurt them in the future, as a combination of the weak economy and people staying at home due to the health crisis will likely lead to more people canceling their overly expensive cable TV subscription and skipping movie theater visit. However, there are at least 3 consolation prizes to be found. First is HBO Max, their new video streaming service, featuring a massive collection of over 2,000 movies and television series, including fan favorites. Second, they are still one of the world's major internet and telephone conglomerates, with the largest market share of cellular users in the United States, which should only continue to expand in the future thanks to their 5G rollout. And lastly, AT&T is a massive cash cow that creates more free cash flow than the great majority of other firms, generating $25 billion in free cash flow last year alone. When you sum it all up, I believe AT&T should be at the top of the list for long-term dividend collectors, despite the fact that they do come with a higher risk. Please let me know how you feel about these stocks, and if there are any that you believe should be on the list. Please let me know which stock you would remove and replace it with. And with that, today's video comes to a close. To express your love and support for this video, click the like button below if you haven't already. Also, subscribe to the channel by clicking the subscribe button below and turning on the notification bell next to it to be the first to know when a new video is posted. Thank you for taking the time to watch, and we hope you enjoyed yourself. We look forward to seeing you again soon.